Hello, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 116. This one is titled, How to Execute a Covered Call Trade with a Buy-Right Combination Form. We're going to be using a real-life example with CORT Therapeutics Incorporated, which trades on the NASDAQ exchange under the ticker symbol CORT. Let's first start by discussing the two methods of entering our covered call trades. The first one is called legging in, and that's where we enter our trade in two distinct trades. The first one is we buy the underlying security, a stock or an exchange traded fund. And once that is executed and we are in that covered or protected position, we then sell or write the covered call option. So two distinct steps. Now, the second way of entering a covered call trade is with a buy-right combination form, and that's where we both buy the stock and sell the covered call option simultaneously. Now, when we buy a stock, we have a debit. When we sell an option, we have a credit. But since the cost of the stock is much greater than the premium we receive when we sell the option, the net is a debit position. So we enter a net debit limit order based on what we want to sell our option for. And that will then create a specific limit order, and the broker is instructed to execute the trade at that price or better. Let's turn now to a real-life example with CORT. And this is a 5-week option chain, which we executed and looked at on 9/8/2020. And CORT at that time was trading at $19.98. Now, the 10/16 5-week out, 21 out of the money strike price had a bid-ask spread of $1.35 to $2.20. That's quite a large spread. Those of you following BCI over the years know that we always try to negotiate a better price when the spread is more than 10 cents. So what we do is we locate the midpoint of the spread. That's known as the mark. And in this case, it's $1.78. Now, when we enter our net debit limit order, we always favor the market maker a little bit. So we drop lower than $1.78. In this case, we're going to seek a limit order of $1.70. Now, if we look at that option chain of the 21 strike, we would see that the spread was $1.35 to $2.20, but we're not going to accept the $1.35. We're going to shoot for $1.70. Now, if we don't get it, we can always reevaluate and go from there. But for the purpose of this podcast, we're going to assume a premium of $1.70. Now, if we fed this information into the multiple tab of one of the BCI calculators, we would enter a stock price of $19.98, a strike price of 21, and a premium of $1.70. The calculator will tell us that the actual time value return on our option, or ROE, for that 5-week time frame is 8.5%. That's huge. And the upside potential, if the price of CORT goes from $19.98 up to that 21 strike, is an additional 5.1%. So that's a potential 13.6% return in 5 weeks. That right away tells us the implied volatility of this security is through the roof. I probably would not use this security because the time value is so high and the implied volatility is so high. But for purposes of this podcast, where we're discussing the buy-right combination form, this is a good example to look at. Now, if we were legging in, again, we would do this in 2 steps. The first step is we would place a market order to purchase 100 shares of CORT at the market price. And $19.98 is what the market price was at the time that I created this presentation. Now, once executed, we would then sell to open that 21 strike with a limit order of $1.70. Now, if we were to use a buy-right combination form, and for those of you who are also watching this podcast, I have a screenshot taken from a brokerage account, and on the top it says buy rights and unwinds. red arrow for those of you watching the podcast. And then we enter the ticker symbol for the stock, CORT, and the ticker symbol for the option, the 10/16/2020-21 call. There'll be a drop down in our brokerage form, and we would just click on the put strike that we're looking for. And then it says order type. Well, we're going to put a limit order. We always do for options. And it's a debit limit order because we're going to be ending up to pay for this. And it's a day only order. So we're going to buy 100 shares of CORT, sell the 21 strike at a net debit limit order of $18.28. That's the 1998 minus $1.70. And we're going to do 100 shares and one contract. And then the sheet will tell us, the form will tell us that the estimated amount without commissions, which is so tiny these days, $1,828. That's our cost when you buy the stock and sell the option simultaneously. Once again, remember to enter this as a day only, because if we don't get our price, we'll reevaluate and maybe re-enter a different net debit limit order. So let's summarize now. Covered call writing trades can be executed in one of two ways: by legging in two distinct steps, or with a single step buy write combination form. Both are good. There's a slight advantage to the buy write combination form when the bid ask spread is small, because then we're not going to leverage that show or fill rule. Or if we can't be in front of our computers that particular trading day, then pre-market we can enter the buy write combination form net debit limit order. Now, legging in may be a better approach when the spread is wider, so we can leverage the show or fill rule. Most of the time I do legging in because a lot of our trades are going to involve only one side of the two steps. You know, we may hold on to a security through one contract period and still own that security and then write another call the following contract month. So, but, you know, there are different types of ways of entering our trades, and only you could determine which is best for you. I always mention our BCI package, our best and most comprehensive investment package ever provided by the blue collar investor. So for those of you new to options, if you're looking to get everything, and I mean everything you need to learn these option selling strategies and related strategies, this is the package for you because it's discounted significantly than if you purchase each individual product, and there are 18 of them. There are 6 online video courses with downloadable workbooks. There are 6 calculators created by the blue collar investor and therefore found nowhere else. 5 of our best-selling books in ebook format, and our annual premium membership subscription, which is 13 months, which includes 4 reports of eligible securities for option selling, along with a huge educational component of our ongoing and never-ending video training courses. And that includes our entire library of Ask Alan videos, where we break down individual trades, either from my portfolio or from those of our members, plus in-depth Blue Hour webinars. And we add 1 additional training video each month. And we add a couple of Blue Hour webinars each year. How to get information on that? Go to our website, www.thebluecollarinvestor.com. Click on the link that says BCI Package, and there's information as well as a video detailing the entire package and benefits that you get from purchasing that particular package. Ladies and gentlemen, thank you very, very much for taking the time to listen to and or watch this BCI podcast number 116, How to Execute a Covered Call Trade with a Buy-Write Combination Form. Folks, I hope you enjoyed this presentation, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.